There are some powerful option strategies that open and close in a single day, which is a sharp contrast to many other option strategies which can last 30, 60, or even 90 days. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and we're very familiar with one-day option strategies, but the issue with them is that when they get into trouble, most traders don't know how to manage them, and instead they just bail out of the trades at a loss, which is often unnecessary. In this video, we're going to show you a trick that options traders use to win a trade, which seems to be going south. So stick around and watch how we take a trade that was headed to the loss column and turn it into a winner. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. In the old days, option strategies were employed over long time horizons, 30 to 90 days typically, but more recently, traders have been focusing on one-day options trades, which have the excellent benefit of not having your trade be exposed to any overnight events, which can occasionally be dramatic, as we all know. Now, the most heavily traded options contracts in the world are the S&P 500 index options, also known as SPX options, and since 2017, the options market has begun making available options chains that expire on Mondays, Wednesdays, and Fridays of every week in the year, which has really been a game changer and allows options traders to execute options trades on the same day those options expire, which means that there logically can't be any overnight exposure because the options expire at the end of each day that they're traded. Now, the one-day trading tactic we're going to show you involves those SPX options I just mentioned. So we're going to do a really quick review of how index options work. And for those of you familiar with how they work, just hang in there. This is going to be quick, and then we'll jump back into showing you how this important tactic for trading options on the day that they expire work. The best way to understand index options is to think of them as bets. What are known as a call option pays off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 4,032, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 4075 call would expire worthless because the index didn't close above 4075, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 4032, then the 4075 put would be worth $4,300 because the market closed 43 points below the put strike price of 4075. But the 4,000 puts, those would expire worthless because the market didn't close below the 4,000 strike price. Now, before we get into how this one-day option strategy works, I wanted to let you know that if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Okay, so now that we know how index options work, let's take a look at a chart of the SPX index in early October, and we can see that it had sold off below 4,400 since hitting its all-time high in early September, and specifically on October 4th, it had opened up at 43.53 and quickly sold off to 43.39 at 10 a.m. So let's say that on that day at 10 a.m., we opened up what options traders refer to as an iron condor trade. And an iron condor trade is constructed by selling calls above the market, in this case, about 25 points above the market up at 43.65, where we sold 4 of those, and then moving 10 points further up above the market, where we buy 4 of the 43.75 calls for protection. Then at the same time, he'd go 25 points below the market and sell 4 of those 43.15 puts, and then move 10 points further down to the 43.05 puts and buy 4 of those, again, for protection. And that formation, with a short call above the market price and a long call above that, combined with a short put below the market and a long put below that, that whole combination is an option strategy known as an iron condor. And it's important to point out that when you enter into an iron condor trade, you actually receive cash into your account at the outset of the trade. And the reason for this is explained on this slide, where you can see that you sold the 43.65 calls for $3.45, but those pay off $100 per point. So you multiply that price by 100 and you sold 4 of them. So multiplying it all together, you receive cash flow in the amount of $1,380 for the short calls. But then you bought those 4 calls 10 points above that, back up at 43.75 for a cost of $6.52, as you can see from the calculation. And with that same logic, you received $2,020 for the short puts at 43.15, and you paid out $1,200 for those long puts at 43.05. And so when you net it all down, it comes to a net cash inflow into your account of $1,548, which gets credited immediately to your account by your broker. And your broker will require for you to engage in this trade $2,452 in capital, which is also the worst case scenario loss on the strategy in this case. And so the premise behind an iron condor is that if the market stays above the short put at 43.15 and below the short call at 43.65, so in other words, if the market stays within that 50-point range between those two short options positions, then all 4 options actually expire worthless. Why? Because the calls only pay off if the market closes above their strike price, and the puts only pay off if the market closes below their strike price, as we explained before. So if the index settles between all 4 of the options, then all 4 options expire worthless, and the trader just gets to keep that $1,540 that he received initially for selling the iron condor in the first place. Okay, so now let's move to 10:45 that morning. And as you can see, the SPX index has further sold off down to 43.03. And so now, as we've discussed, there's a distinct possibility that the market may not recover from this sell-off, being that it's already down 53 points in the first 75 minutes of the market. And so to assume that the index will close between 43.15 and 43.65 when it's already down to 43.03 is a little bit questionable. So we now get to the real purpose of today's lesson, and that is to show you that you don't have to just sit there like a sitting duck, but rather you can implement a modification to the trade, what options traders refer to as adjustments, to help the trade to win when it's falling into a potential area of distress. And so in this case, we're going to implement what options traders refer to as a roll, where we basically widen the zone where the trade can win. And the trader accomplishes that by, first of all, closing the original put side of the iron condor. And he does that by reversing the original transaction on the put side. So he buys back the 4 short puts at 43.15 and he sells the 4 puts at 43.05 while simultaneously setting up a new short position at 42.90, which is 25 points below the original short put position. And he also buys a new long put position at 42.80. 10 points below the new short puts at 42.90. So if you think about it, he's just reestablishing the position of the put side of the trade, moving it down 25 points for both the short and long puts. And now it's important to realize that this is not done for free. There's a cost to doing this. And to make money on an iron condor, it's important not to spend more than the original cash flow you got in from the original iron condor on adjustments. And you'll see in a few minutes just why that's so important. So let's see if we've spent more than we had originally brought in or not. And so if we take a look at this slide, we'll see that we had to pay $81.80 to buy back the original short puts at $43.15, and then we received in $6,040 for selling off the long puts we initially bought. So that gets deducted from the cost, and then we sell to reestablish the position at $42.90, the 4 puts for $36.20. So that further reduces the cost of the roll. But then we need to reestablish our protection at $42.80, and so those 4 puts cost us $2,500, as you can see. And so when you net it all down, the roll itself cost us $1,020. And so remember, the original iron condor created positive cash flow of $1,548, but the roll now essentially spent some of that. And so after the roll, we've still got $528 left over, and you'll see in a minute just why that's so important. Okay, so now here is the new position. As you can see, the original put side is gone, and the new put side position is down at $42.90 and $42.80, 25 points below their original position, as we mentioned. Okay, so now let's move to the end of the day, and as you can see, the index closed that day at almost exactly $4,300. And remember, the options are expiring that day, so let's take a look at how they settled. And as you can see, the calls both expired way above where the market closed. And so since they only have value if the market closes above their strike prices, those call options just go out worthless. And the same is true of the puts, because those closed below the market price. And so since they only have value if the market closes below their strike prices, they also expire worthless, leaving you with that $528 that was left over from the original credit you received on the trade once you implemented the roll to widen out the condor and give yourself the opportunity to be in the exact position that you wanted to be in, which is to have all 4 options expire worthless, putting you in a position where you can just walk away with that $528 simply because you had the knowledge to roll the trade and save it from being a loss. You see, that original position would have been a totally different story. You remember the original long put position was at 43.05, so that would have expired at 454 in the money, because 43.05 minus 4,300.46 is $4.54, and you owned 4 of them, so you'd be paid $1,816 by the one you bought the puts from. But those short 43.15 puts that you sold expired $14.54 in the money, so you owe the guy you sold those to $58.16, as you can see from the calculation, because those closed 10 points deeper in the money, and so you owed so much more on those. Now the calls both expired worthless, obviously, as they're still so far above the money, but take a look at what the final tally of the situation would have been had you not rolled it. Even bringing back in the $15.40.80 that we received in the beginning of the trade, it still doesn't even come close to compensating us for our loss, which would have been $24.52 had we not rolled. And so what I'd like you to take away from today's video is the fact that there are easy fixes in options income trading when a trade does not work out as originally intended and the market moves outside of the winning zone of an iron condor. Professional options traders are trained to implement these fixes, which give them a much higher win rate on their options trades than a typical untrained retail trader who may not understand that you don't need to be a sitting duck once you've put your position on. You can modify your trades to widen your chances of a win once you understand how to execute these kinds of changes to your original position like pro traders do all the time. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to click on the subscribe button right now so that you won't miss any of the free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.